bear markets don't end with people wanting, trying to find the bottom. Bear markets end when people are like, I don't want anything to do with the stock market. I'm done. I'm out.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap. And as usual, I'm joined by my good friend Lance Roberts. Lance, how you doing, buddy?
Well, it's Friday. Glad to be here.
All right.
This is the best. This is the highlight of my week because it's the last thing I do on a Friday before I quit. So yeah, this is great.
Good. All right. It's almost the last thing I do. We then have to edit all this, but hey, it's all for a good cause. All right. Well, look, let's start with the theme of the week. I'm going to put out Road to Nowhere as the theme because we kind of bounced all around this week, but we're kind of ending back more or less sort of where we started. I guess I will say notable this week is yesterday was yet another sort of, disappointing failed, breakout. So what do you take from this week's action?
Well, no, so it's actually, so let's back this up just a little bit because, we've been talking about, hey, we need this reflexive rally. And the other problem, and we noted this in last weekend's newsletter, talking about all these trap longs. So all these people that have been just, got really kind of hammered this year, they're all kind of looking for an exit, and they don't trust these rallies now because every time we have a rally, particularly over in April and May, every time we had, a one-day rally of some sort, it would just completely give it up the next day. So you never had a chance to get out. They just kind of get, we're just getting hammered all the way down. So if you take a look at the market right now, and I'm going to throw out some technical mumbo jumbo here, so just bear with me for a moment, and we can dig into a little bit more if you want. But where we rallied to, so we got above the 20-day moving average, and that happened last week, and that was actually very bullish. So we got above the 20-day moving average. We turned the MACD kind of signal onto a buy from a very low level. Typically, that suggests when you got to get that kind of a buy signal from a very low level, you tend to get some follow-through participation in the markets, and we did get that last week. But we ran right into so if you measure the decline from the March peak to the May lows, the rally last week, which wrapped up the month of May, and ironically, May was a terrible month until the last couple of days, and we actually wiped out all the declines of May in just a couple of days. But that retraced us back to what we call a Fibonacci retracement level. There's three kind of basic Fibonacci retracements: a 38.2% retracement. So from the peak of March to the bottom of May, we retraced 38.2% of that. The next level is 50% retracement. The next level after that is 61.8%. And then if you get above that, you're going to go back to where you were back in March. So that's kind of the four kind of primary levels. But there's some other things that are occurring in conjunction with those levels that are really creating a lot of resistance. So at 38.2%, which is where we ran into it on Monday and failed at that level, that's also all the lows that we had back in April. We had this kind of couple of week period where we kind of bounced around this level back in April. And that's also the lows that we put in back in February when Russia initially invaded Ukraine. I know that seems like a bajillion years ago now, but it was just February. So you have this kind of these previous lows that were broken. That is now acting as resistance. So as prices come up to where those broken lows were before, all these investors that were kind of trapped in the market are going, hey, get me out. Now, if we can get through this level next week, now again, we're still, on a buy signal. We haven't violated that yet. And in a short term, the markets are overbought. So this little bit of a pullback here today, really not surprising, but we need to get above those lows from April and February. And if we can do that, we've got a shot to get back up here towards the 50% retracement level, which is about where the 50-day moving average is. And I think that one's going to be a much tougher kind of hill to get over at that point, just because there's going to be a lot of price at that point where a lot of investors are going to be wanting to get out of the market. So again, I can't reiterate enough. We talked about using this rally to reduce some risk in your portfolio. So, and we talked about the fact that the average retail investor is down like 30% this year, and the markets aren't down that much. But this is where a lot of investors have gotten into it. And we talked about using this rally to raise a little bit of cash. And I would continue to suggest doing that. We raised some cash this week when we got to that 38.2 retracement level. We sold a little bit, reduced a little bit of exposure in the portfolio. Not a lot because we're already carrying, a good bit of cash. But if we get another rally up here, we're going to do that kind of same process again and raise some more cash and reduce some more exposure. And I think that's just really the exercise here for the next couple of months, because, despite the fact that we have a tremendous amount of bearishness, hedge funds are very underweight equities. The month of June is the last month of the second quarter. Now, why is that important? Well, because all these pension funds, hedge funds, mutual funds, et cetera, that run allocation models, 60, 40, 80, 20, 70, 30, whatever, they've all got to rebalance their portfolios. And because of the decline in bonds and because of the decline in equities, they're all out of tolerance. And so they're going to have to buy back equities to get their 60% equity exposure, have to buy bonds to get their bond exposure up to target weights before the end of the quarter. That's what we call window dressing. And so there is some reason to expect that we're going to get some buying kind of continuing on this month. So again, just because we failed at this initial resistance level doesn't mean the whole ball game's over. And now if we retest lows and break lows, that's a whole different ball of wax. And we'll talk about that if that occurs. But again, we're kind of in this little bit of consolidation process. We need to make a little bit move higher here by the end of the month. But having said that, we have a lot of bearishness. We've got, from a contrarian standpoint, we talked about last week, 8,200 articles being written on bear markets. Everybody's bearish on TV. CNBC's running market turmoil, and, every day Adam's yawning right now as I'm talking because I'm boring him to death. So these, but those are all signals that you should get a rally in the markets. And we haven't been able to muster that yet. So I think that is concerning. And then we also have the Fed starting their quantitative tightening this month as well, and hiking interest rates this month. And that's another headwind that we're going to have to deal with. So I know it's a lot to kind of compact in here just to start off a conversation, but that's really the gist of what happened this week.
All right. No, you did a good job, and apologies for the yawning. Don't take it personally. Last night was grad night at my daughter's high school. So I was doing the graveyard shift. Yeah.
I did that last weekend.
Did you? Okay. Yeah. So dad, just one of the dad, rites of passage we have to go through.
Exactly.
All right. So totally makes sense. It sounds like even, sideways isn't even so bad. When you take into the context that the longer we go sideways, the more we're kind of burning off the overbought status.
Yeah.
The market's trying to get back up, and what was once a floor is now becoming a resistant ceiling. But we made it to the first Fibonacci level, and the question right now you're saying is, hey, can we make it to that next one? Right. You say, look, it's going to get a bit harder because as we get closer to it, more of those trap longs are going to use it as a way to kind of liquidate, which it sounds like you're not that you're a trap long, but you're going to be using it for the same reason too, which is as we get up near there, you're going to continue to lighten up because, it sounds like you still don't place a lot of faith in the longevity of this rally, right? You think that all things considered, there's enough risk to the downside that you're playing more defense than offense right now. I will say, just on the contrarian side, probably the biggest contrarian that I interview on this channel, a guy named David Hunter, who has made some really big, bold predictions and has been getting beat up for him a lot as of late. But he is sort of quintupling down right now on the big melt up, his big melt up call, which is a melt up that precedes the meltdown. But he is saying, hey, look, cards are in place here for a much bigger melt up than the world expects. Not saying that's going to happen.
No, it's funny you said that, because I'm actually, kind of working that same kind of a theory here, and, in my mind, because here's the problem. And David Hunter's right from this perspective. And again, when we, I hate using terms melt ups and meltdowns and this type of thing, because it's, everybody kind of extrapolates whatever that's supposed to mean. But here's the problem. Let's just assume that tomorrow we go into a recession and a bear market. Okay. If that would happen tomorrow and the market's declined by 20% and we have, and the, the TVL announces that we're in a recession, this would be the only well forecasted bear market and recession ever in history.
Right.
Because, everybody's bearish. Everybody's talking about a recession, and nobody ever calls these things right, and they never call them in advance. So to David Hunter's point, and this is the conundrum that and this is the conundrum that we're in. And to your point, we're using the rally to sell into, because everybody's so bearish that we've got to have. Now, I'll explain what I'm about to say contradicts what I just said about lightening up, but I'll explain to you why here in a second. Mm-hmm. But everybody's so bearish that we need a really big rally here to get all these people off of being bearish. We need to get Jim Cramer on CNBC going, see, I told you the bear market's, done. It's over. The bear's dead. The bulls are back. I was just on Fox Business News on Friday with Charles Payne asking me the same thing. He was like, well, are we there yet? Right? Is this the bottom? My suspicion is no, it's not the bottom, but we really got to have, a 10, 15% rally. That doesn't get you back to new highs, by the way. A 10, 15% rally to get people to get off of this bearish bandwagon and get back on a bullish bus. Yeah, exactly. And then that's what happened. But see, that's the way markets work, Adam, right? Bear markets are really great about luring people in and then mauling the crap out of them. I mean, that's, think about, I've written an article called The Revenant talking about the 3 stages of a bear market. And that's what bears do is they knock you down, they maul you, then they go off a little bit. And just when they think, you think you're out of the woods, they come charging back and they maul you again. And that's what a bear does in the bear market in particular. So we've got to get these people off of being this bearish. But here's the conundrum, though, right? We've got the situation where we have this uber bearishness, which should lend itself to a fairly strong bull market rally. So why am I lightening up into this fairly strong bull market rally? Because we've got the Fed now going to hike rates by 50 basis points this month, and the Fed's going to start doing their QT this month, $60 billion, and that's going to increase to $90 billion by August. So they're extracting liquidity out of the market. We've got this raging inflation going on at 8%. That's causing creative destruction, with the consumer. So they're going to start to slow down a lot more as we go on. So we've got all these economic and macro fundamental impacts into the markets and the economy as well, which, what our position is now is that here's the answer. I don't know what the hell the market's going to do over the next 3 months. So my goal is lighten up on the rally in case we do have the most well forecasted bear market and recession in ever in history. And then if the market proves me wrong, that's okay, because all I've got to do is just go put capital back to work, right? So and you miss out on a 10%, 15% opportunity cost, not the end of the world. Right. Well, no, it's not even that, though, because remember, we're not 100% cash, right? So we measure everything about relative performance in our portfolio. And so we track our benchmark relative to our portfolio works. And our big worry over the last few weeks is if we have a really strong market rally. So we, about 3 weeks ago, before we had this rally, we were about 500 basis points above our benchmark. So lots of breathing room relative to our benchmark. And so our big concern was if the market rallied 5% or 10%, we would give up all that lead. But because of the way the portfolio is structured, we only gave up 1% of that lead, even though the market rallied almost 7%. So, the beta volatility structure of the portfolio kept our lead structure in place. And so that's taken some of the pressure off us right now. So we can let the market run. We still have cushion. We can let the market run with us right now because our portfolio is performing well on the upside. And so that gives us more room to breathe here. But the more we lighten up, the bigger that challenge is going to become of potentially getting on the wrong side of the trade. And again, we don't want to have so much cash that if this market does revert itself and somehow miraculously we go back into, a bull market and everything's great and we're all happy, and Jim Cramer's right, then, we've got to pretty quickly get allocated back into the markets. I don't think that's going to happen. I think this is more of a Bear Stearns type issue. And my partner, Michael Leibowitz, wrote an article this week on our website at realinvestmentadvice.com talking about the Bear Stearns rallies. And he says, go back and look at Bear Stearns. And we had this huge 15% rally after the Bears, after Bear Stearns was closed down and sold off to JP Morgan.
Right, yeah.
And everybody thought that, hey, everything, we're golden, right? Ben Bernanke, subprimes contained, Goldilocks economy, it's all good. Everybody was back to being bullish, and the bear came up and mauled everybody right after that. So that's the scenario we think plays out here. We just don't know exactly how it's going to play out just yet. So we're being a little bit cautious.
All right. Yeah, no, a great reminder. And I think, as we've said before, the goal of a bear market is to take as much money from as many people as possible. And a huge part of that is sucking people back in, right? And then pulling the rug out from under them. But, to your point too, it's tough, right? Because just released a video yesterday of Stephanie Pomboy interviewing Peter Atwater. And Peter's big focus is on confidence, people's confidence in the system. And you make decisions based upon how much confidence you have in a potential outcome, right?
Right.
And his point on reflecting on the markets today, Stephanie asked him, so is this bear market over? And I know we can bicker back and forth about whether we really triggered the bear market flag or not. But, what Peter was saying is he's like very clear that people are sick of the declines, that have happened so far this year. They're tired of it. They want it to be over. They're like kids in the back of the car asking, are we there yet? Right. And he said, the thing is, there's never been a bear market in history that's ended because of fatigue. Right. They always end with despondence. Right. And he's like, and we're nowhere near there right now. Right.
Exactly.
Yeah.
No, he's absolutely right. I think you and I talked about that maybe a couple of weeks ago as well, is that bear markets don't end with people wanting, trying to find the bottom. Bear markets end when people are like, I don't want anything to do with the stock market. I'm done. I'm out. And I've got too many people emailing me, calling me, et cetera, going,
their fingers on the buy button, ready to go.
Yeah, right, I'm ready to go. I'm ready to, I sold my house. I'm ready to go put all my money into stocks. Just tell me the day to do it. And A, markets don't work that way. And B, that's not how a bear market ends. So this is either a big correction, and at some point we're going to look back and go, yep, that was a correction. Like March of 2020, huge correction, came down to long-term bullish trends, bounced right back up, went to all-time highs. So that's a correction. Bear markets don't do that. So this is either a correction, and we're going to look back in 6 months or a year and go, yep, that was a correction, and we've rallied back to new highs and everything's golden and we're all good. I don't really see how that happens, but hey, anything's possible. Or we're going to get into a bigger bear market, and by the time we get to the end of this, nobody's going to be watching our videos on Fridays.
Right. Or we're going to have to just turn it into the good news channel to try to just keep people from jumping off the ledge. All right. Well, look, that's a really good segue into the rest of the schedule here, the rest of the agenda. And I got to warn you, lots of bullet points. We almost finished number one. I'm just going to go to number two just to get things rolling here. Okay. But there, in terms of where things go next from here, I just want to note that there has been a whole lot of talking going on with a lot of the people who are kind of in charge of determining what happens next. So we've had a number of Fed speakers come out this week. Most notable of one was Raphael Bostick, who last week kind of juiced the markets by saying, hey, maybe it's worth taking a pause in September and seeing if we actually really need to continue to do any more rate hikes. Markets took that as like a green flag to just say, okay, Fed is already beginning to think about throwing in the towel. He got pushed out this week to say, hey, you better walk that back, buddy. Yeah. And he did. We had Lael Brainerd, formerly the biggest dove on the FOMC. Now it's still talking a lot like a hawk. Basically, I think to kind of try to contradict Bostick's earlier statement, said, hey, look, she's not saying inflation has peaked, and has then said, right now, it's, quote, very hard to see the case for a pause in September. We then had Loretta Mester of Cleveland Fed come out to talk even more this week, saying that, look, the Fed's going to have to be strong. It's going to have, quote, fortitude in the face of what could be really volatile markets. But then she said slowing growth and even a rise in unemployment. So now the Fed is really beginning to try to set expectations that, hey, folks, there may be layoffs in the future. And you and I talked a lot about that last week. So basically, rate hike expectations dropped last week after Bostick made his comments, they have slingshot back up again. So here's what the market's pricing in right now: 50 basis points in June, 50 basis points in July, 50 basis points in September, 25 in November, 25 in December. I mean, that's a lot of rate hikes between now and the end of the year. Last point I'll say on the Fed speakers is Bullard then came out, James Bullard, and said that the Fed is in danger of losing control of the public expectations of future inflation. And of course, that's their hugest fear, right? Because if people think prices are going to be higher tomorrow, well, they start changing their behavior and they basically continue this. It starts becoming a vicious cycle higher, right? So there's a lot of Fed guys out there trying to, do what they should have done a long time ago, which is to dampen expectations, take that punch bowl away, make people feel depressed. I see you smiling as I'm saying all this. So I'll pause here. I've got some more speakers, but let you react to this.
No, I think it's great because, first of all, these, we give way too much credit to the Fed. I track every quarter they come out with their economic predictions, right? And they post this table of where they think the economy, inflation, and unemployment are going to be over the next, year, 2 years, and 3 years, right? So they have this kind of forecast of where they expect inflation. I track this every quarter, and I've created this whole Excel table out of these predictions. And they're never right.
They're always wrong, right?
Yeah, they're not even close to being right. And I mean, if they were in the ballpark of being right, maybe we give them some credibility. But they're terrible. They're so bad in terms of economic forecasts. It's just ridiculous. And these are the guys that are running our monetary policy. And so they trot these guys out all the time to say stuff, and they come out and they say these things, and look, a lot of these are trial balloons, right? They're monitoring how the markets are going to react. So Bostick drew the short straw. Okay, you run out and say this. Let's see what happens.
Right, I'm sure that was an intentional trial balloon. Yeah.
Oh yeah, it was. And so the market's rallied. So awesome. Okay, now go trot out this thing. We're gonna walk that back now. Let's see what happens. Well, the market's pulled back here a bit, but it didn't fall apart. So now the Fed's they've got a little bit of test out there going, okay, we've got some room here to potentially keep rates a little bit tighter and kind of see how things go. We can pretty much get into September, probably do 350 basis point hikes, and then we'll have to figure out where we are from there. But these are all trial balloons just to see how the market's going to respond. And when they come out and say something, the market falls apart, then they'll start walking this stuff back. But that's really the thing is I would pay a whole lot less attention to what the Fed says and more about what the market's telling you. And what the market's telling you and what market participants are telling you is that there's a lot less room for the Fed to hike rates than what they're talking about. I think they can probably get 150 basis points off by September. But at that point, the economy is going to be cracking. You're going to have unemployment on the rise. You're going to have jobless claims spiking, and keep a watch on jobless claims. Record low jobless claims are always pre-recessionary. So we're to that point where we've got the potential here for a very rapid unwind in the economy, employment, and all these things that are very important to the Fed that's going to cause them to start backpedaling on all this monetary policy talk.
Okay, well, so you're taking this where I want to go. I might, I don't want to say I disagree with you, but
it's all right. You can disagree with me.
No. So here's what I mean. So there was a tweet from Zero Hedge right before I got on here with you that said, every time a Fed president speaks, stocks immediately puke. So, I actually think the Fed is okay with stocks going down at this point. They just don't want them to go down too far, too fast. But I think that they are trying to engineer a manageable negative wealth effect here because they want to be bringing down overall demand.
Okay, but hold on. Okay, two things, right? And I wrote an article on this last week. So you've got to look at it differently from the standpoint of how the Fed looks at the stock market and how you look at the stock market. And this was the point of what the article was about, is that we've all been trained to look at the stock market by where did we start January the 1st and where are we today, right? So, oh my gosh, we're down 20%, 15%, wherever we are right now. So terrible. Why isn't the Fed bailing out the markets? I don't understand why the Fed's not in here. We've obviously got a bear market going on. Why aren't they in here bailing out the markets? The Fed doesn't look at the market that way. The Fed looks at the market saying, okay, what's the wealth effect in the market? Because again, Ben Bernanke laid that out in 2010. He made the statements is the reason we do QE is to boost asset prices in order to increase consumer confidence, which will lead to growth in the economy. That's QE in a box, right? That's exactly why Ben Bernanke did it in 2010.
Right. So, and QT should be the inverse of that, but yeah.
Exactly. All right. So, but we haven't done QT yet. That just starts now. So,
right.
So the Fed's looking at this going, okay, where were we at the peak in 2019 or in 2020? Sorry. Where were we at the peak in 2020 and where are we today? Well, we're still 15% higher than we were in 2020. So from the Fed's perspective, we're still up 7% a year. And so the average wealth effect for the average consumer is still 7% a year higher than it was in 2020. So there's no risk for the Fed right now in terms of the markets because that wealth effect is still in the markets. People are wealthier than they were 2 years ago. Now, when this thing starts to crack enough that you begin to create what we call financial instability. So that's the other big risk here, right? Zombie companies can't refinance. You get enough of a wealth contraction in the markets that you get this massive kind of slowdown in the economy. You start getting deflationary pressures. Yeah, the Fed's going to start to back up real quick because now that wealth effect becomes much more important.
Right. So, okay. So exactly. That's where I want to tie all together here, which is the Fed, I think is, and where I'm going with this is sort of don't fight the Fed has been a very successful strategy for the past 12 years. Right. I think we may make a good argument that it's a good strategy now. Right. Which is like,
it is.
Don't fight the Fed now that it's trying to, bring the party down a little bit, right? So bet more on the short side, bet more that asset prices are going to come down because that's what the Fed's trying to engineer. Now, that being said, I think what could easily happen was what just happened a year and a half ago, where the Fed, wanted more inflation, right? And they finally got inflation, but just way more than they expected, right? So I think they're gonna try to engineer this soft landing of depressing demand enough. But they're gonna pass the event horizon, and they're gonna end up creating something a lot worse than what they intended. And that's your point. That's when they break something. That's when they come back and pedal back all this stuff. All right. So now I'm gonna switch to another guy who spoke recently, which is Jamie Dimon. And I would listen more to Jamie Dimon because he's in the business of having to make money based upon what goes on here, right? The guys at the Fed, they're just grand poobahs who are just coming up with policy, and whatever happens. Jamie Dimon's got a mandate. He's got to make more money this year, than he by the end of the year than he started at, right? So he came up with this term that's been in the media, for the past couple of days. He's predicting a quote economic hurricane caused by the war in Ukraine, rising inflation pressures, and interest rate hikes from the Federal Reserve. So he's basically telling people, quote, you better brace yourself for what's coming. He's also very worried that the start of quantitative tightening is going to worsen things even further. He said people will be writing about this in history books for 50 years. And then he also talks about his concerns about the impact on oil prices, thinking they could go as high as 150 to 175 a barrel. So he's basically saying, look, guys, I see a lot of tough times coming ahead. And so, I agree with you. Don't necessarily listen to what the Fed, don't put a lot of faith in their specific predictions about where the puck is headed because they're such horrible forecasters. But guys like him, their opinion and their predictions carry a lot more weight, I think, because they've actually got a lot more at risk based on it. What do you think?
No, they do. And look, I'm not a big fan of Jamie Dimon for a whole variety of reasons.
Oh, as a person, yeah, absolutely.
Well, no, he said some pretty awful stuff previously. I've written articles on. I mean, here's the guy. He's so detached from the average American to start with. I mean, he makes these comments and stuff. It's just like all these guys. He was over in Davos with everybody else, and they're talking about how we need to switch to a diet of crickets and seaweed, right?
Right. I was going to say let them eat cake, but let them eat bugs, right?
Yeah. Exactly. All of us, we're supposed to eat bugs, to save the climate, but they're not, right? They're flying around in private jets. They live a very different lifestyle. But to your point, he's right. And I'm actually going to write an article kind of dovetailing off what he said on this economic hurricane, because I think that's a real risk. The problem and where I think the Fed makes a mistake, and we've talked about this numerous times on our weekly shows, is that the Fed is the Fed lives in this kind of stationary environment. They're looking at inflation and economic growth and unemployment as an isolated event. And they're going, okay, we need to hike rates to bring down inflation. But what they're forgetting is what caused the inflation, right? Which is all this money we inject into the system. Well, that's all coming out. So inflation is going to take care of itself in the short term. So if you just leave stuff alone, inflation is going to take care of itself. And that's just a function of the process and the environment that we're in. Oil prices will take care of themselves. Supply and demand is going to work itself out. And that's just a function of how things work. Yes, we can have higher oil prices in the short term, but as soon as we resolve something with Russia, Ukraine, or OPEC produces more, or we produce more here, whatever, or just you get a slower economic environment, demand drops, you're going to get an increase in supplies and oil prices are going to come down. So that's all going to work itself out. So we have a choice to either let the economy function, and maybe this is what the lesson we need to learn in all this, leave things alone and let the economy do its job of, solving recessions and solving expansions, which it will, or we can keep interfering with it and causing boom and bust. And that's what we've done. And so we created this whole boom with artificial influence. Now it's already trying to take care of itself. We're already seeing the impact of money coming out of the markets. New orders for manufacturing companies are dropping sharply, and employment for these manufacturing companies are already starting to come down. We're already starting to see that hard data economically starting to slow here fairly quickly. The Atlanta Fed just ratcheted down their GDP for the second quarter down to 1.3% on June the 1st. It probably came up a little bit with the employment report today, but it's not really great. And of course, negative 1.4 in the first quarter, that's zero for the year. That's not a booming economy by any stretch of the imagination. But now the Fed's going to layer on all this because they're looking at that inflation going, I got to hike rates like a madman, and they're going to break something. It's just a question of when and how do they break it. And so Jamie Dimon's right. The only question is do they stop soon enough and start reversing to tamper the decline you're going to have? So in other words, instead of having an economic hurricane, we have just an economic rainstorm.
Right.
That's going to be the question.
I'm just curious, what probability do you put on that? I mean, I don't put a ton of faith in these guys being able to engineer a soft landing in anything, even a Kleenex tissue.
Well, let's just go through history and we'll just weight it for how many times they engineered a soft landing versus how many times they didn't. And that would be zero.
Yeah, so exactly. All right. So so again, you're talking exactly where I'm trying to bring the puck here. So we had the payroll numbers come out today, which were stronger than expected, but it still dropped to 13-month lows. So it wasn't a great number, as you've said a couple of times. It also it's been interesting. We've been seeing in the past couple of payroll reports more contradictions with the ADP job reports, and people oftentimes argue that the ADP are a little bit closer to reality. I mean, the BLS, which puts together the payrolls that came out today, I mean, a lot of people call them the Bureau of Lies and Statistics for a lot of I think well-deserved reasons.
There's a ton of problems with the BLS report is the BLS report. It's what we've got to work with, right? We've got ADP, we've got BLS, and look, it's a terrible report. On the second Tuesday of every month, they call 30,000 households, and they call the same 30,000 households for 6 months in a row. And they say, hey, Adam, are you working? And you're sitting around the house in your underwear with a pizza box, and you're like, yeah, I'm self-employed. I'm working. I do videos on Fridays with this guy named Lance. Yeah. So they go, oh, okay, he's employed, right? You may not be, you're not actually working, right? It's just, you claim you're working. So this is really kind of shady math. But then there's all these other adjustments they do where they're going, okay, well, let's assume, a bunch of people just, Adam didn't actually go to work, right? He's not working for somebody. He went and created his own company. So we have this birth-death adjustment for new businesses. Well, the problem is their birth-death adjustment, which adds about 200,000 people to the roll on an annual basis, is wrong. We haven't been increasing the number of small businesses in the last 12 years. And so those have been pretty flat in terms of how many new businesses exist because they come in and they die and et cetera. So their numbers are just flat out wrong. They're overstated by about 12 million workers. The actual employment in the country is far worse than it looks like. But that also jives with why we keep running super low rates of economic growth. If you had really strong employment, you would have 5 and 6% rates of
You'd have the
economic
growth
growth
to show for it. Exactly.
Exactly. So, but anyway, my point is that's a whole nother conversation we'll have about the lies and statistics of the BLS someday. But, it is what it is. That's what we have to work with. I suspect now, remember also with the BLS report, we revised those numbers heavily in 12 months and in 3 years.
Yeah, exactly.
So in 12 months, we're going to look back and go, oh, it wasn't 300,000 jobs. It was a negative 100 or whatever it was. And it'll start to come in line with all this other data we already know exists. So again, the employment report means very little to me. I don't know why people pay so much, give it so much importance.
Well, they do, but you're making the point I wanted to make here, which is first off, it's a heavily juiced number. Yeah. And it still wasn't good, right? No. That's what I'm saying.
Right.
ADP numbers suggest it's worse. You and I have been talking about, the potential vulnerability of the jobs market. I think we spent a fair amount of time either last week or the week before talking about it. But there's a progression that you go through in an economy when jobs begin to dry up. First, you have companies put in a hiring freeze, right? So they just stop taking new applicants.
Yep.
Then they start cutting hours if they have hourly employees where they can do that. And only then do they then resort to layoffs, right? So it's what's generally good about it is you normally get some advance warning before American companies start shedding, lots of people at scale because the hiring freezes start beforehand. Well, what's interesting is we're now beginning to see a lot of hiring freezes. I mean, Tesla this morning, Elon Musk just said, "Hey, I'm implementing a company-wide hiring freeze at Tesla. And to be honest, I think we're going to have to lay off 10% of our workforce." Tesla employs about 100,000 people. That's 10,000 people right there. I've mentioned a tech startup layoff tracker that I've been following. I'll try to put the most recent chart of that up here. But we just finished the month of May, and you can see that starting in April and then very much in May, we've very quickly returned back to the levels that we were at right in the middle of 2020 when we were shutting the entire global economy down, right? So, we're already seeing the fact that the labor market is beginning to dry up pretty fast. I just saw a stat. I don't think I have it here with me here, but that's something like 25% of potential retirees are now delaying their retirement plans, given kind of the storm clouds that are showing up here. We've talked about this whole I'm forgetting the word, the Great Resignation. I predicted that it's going to very quickly morph into the Great Unretirement Party, and I think we're beginning to already see that, right?
Well, yeah. So, you have to remember too, and the point you're making, which is super important, and I think people need to know this, is that companies are slow to hire, slow to fire, because coming out of a recession, companies are really slow to ramp up because they're not sure we're out of the recession yet. So I don't want to hire a bunch of people and have to turn right around and lay off, because hiring somebody is super expensive. I'm not only just hiring them, I've got to pay taxes and house them and give them computers and all that.
OSHA and healthcare and all that stuff. Yeah.
Exactly. And then benefits and all the other stuff.
Workers' comp.
Right. And then you spend a year training them to make them a good employee. And this is the problem with job hopping right now that we saw going on. It costs companies a lot of money to train people, and they go hop jobs to get a better job. So companies, though, they're slow to hire for that reason, but they're also very slow to fire. So to your point, first thing I do is I'm just not going to hire anymore, but I'm not going to hire anybody else. Then I'm going to stop giving pay raises and just tell everybody, say, look, be happy you've got a job, because I'm not going to lay you off. I just can't give you a raise or a bonus. And then when things get really bad, then of course they're like, okay, I've got to let people go. But companies hate letting employees go because, again, if you've got good employees, like everybody in our firm, if you said, Lance, you need to fire somebody in your firm today, I would be really hard pressed, because everybody in our firm is a great employee. I mean, they work hard, they're smart, they do a great job, they're super personable. If people are not good employees, they don't last long in our firm because the employees will run them out for the most part. But that's the problem with most companies is that once you've got really good employees, you train them, you spent this time, the last thing you want to do is let them go, because then they go to work for one of your competitors, right? And they know everything about your company. So companies try to hang on as long as they can until things get pretty bad. So slow to hire, slow to fire. And I think that, we've got to get a little bit more down the road here on this economic downturn. But by later this year, I think we're going to see that unemployment number jumping pretty quick.
Well, I agree. And just a quick quote here from Dawn Fitzpatrick, who's the chief investment officer for Soros Fund Management, right?
Yep.
So she works for Soros. Uh, she says the quote, the bottom line is a recession is inevitable. It's just a matter of when at this point. So, you combine that with Dimon, and you combine that with the fact that the Fed and everybody is trying to bring demand down here, and everything that you and I have talked about, all the other sort of stress fractures that we're seeing. I just want to continue to beat this drum for folks here, which is that the probability of recession continues to grow here at this point. And so I just want to make sure that people are at least having that inner dialogue with themselves of, okay, have I taken enough assessment of my personal situation, and have I done am I doing the things I can do now to make myself less vulnerable for what might be coming down the road? Because the more and more I look at this, the more I feel like, who knows what might happen. But I think it's almost unavoidable at this point, and that seems to be what Soros thinks.
And I want you to be careful though, just with this, because I don't disagree with you, right? Here's the problem, right? So, or I shouldn't say it's a problem, but we go back to what we were saying earlier in the show, is like, this would be the most well forecasted recession ever in history, right?
Right.
So here's the problem: it's always timing, right? And this is going to be, I think, the timing here. Okay, so Lance, do you think we're gonna have a recession? Absolutely. I think there's 100% probability we're going to be in a recession. When is it going to happen? Don't know. And the reason I say I don't know is because, again, you have so many people trying to predict the recession. And to your point, they say, hey, we need to prepare for it. Well, immediately my first response is oh, crap, I'm going to go put everything in cash because Adam just said there's a recession, must be going to happen tomorrow. The problem is that it may not happen for 6 months or 9 months or 12 months before we actually get to that recessionary bend, because again,
or at all. I mean, got to keep the door open, or at all, right?
Yeah. I don't think there's a possibility we get out of this without a recession. Okay, I'm going to agree with Soros's guy and Dimon and you. I don't think there's a way we get out of this without having a recession. There's too much liquidity put into the system that was artificial. You're going to have that payback. And there's just no way to support that economic growth. And unless we start getting a whole bunch of checks out of the government again. We have the midterm elections come up in November, and we sweep in a whole bunch of new people, and they all say, guess what? MMT's here. And so we all start doing MMT, so we avoid a recession by sending checks to households. Again, artificial growth. It's just going to mean that it still doesn't mean you're not going to have a recession. It's just going to get pushed out another 12, 18, 24 months, right?
Right.
So I just want everybody to be careful. Is a recession coming? Yes. Is it coming tomorrow? No. When is it going to be here? I have no idea. And this is why we've got to go back and trade the markets for what it is. And if you've got the fortitude to be short the market and ride this thing out, it could be 12, 18 months, and it could be very painful in between this point between A and B. Because the market may run against you. And again, as I said earlier in the show, as we started this thing, I don't see how we get to the recession part without getting all these people off of this bearish camp.
Right, sucking in some more people with some false optimism. This is a great clarification point. And just to be super clear, I'm not telling people sell everything you have and just hunker down in cash. And you're also making a point I would make anyways, which is, find your financial advisory partner and make sure that they have a plan and you're just trusting the plan, right? That's what you're counting on the experience of an advisor to do, especially in periods like right now. What I was really more talking about is like, if you don't have a 3-month or 6-month emergency savings in squirreled away in case you suddenly lose your job unexpectedly, like, that's the type of thing you really should start prioritizing right now.
Yes.
Do the question of like, hey, if my company were to downsize or shut down, where are employers in my area that I'm interested in that I think would survive that? And maybe I'd start taking people out to coffee there just to start, building a relationship. Or maybe I should talk to the people in my family and say, hey, if one of us gets laid off,
who's got a spare
can the
room?
Rest of us, circle the wagon. But can we come up with some agreement now and how we'll support each other or whatnot? It's that type of stuff. I just want to make sure that people, if this indeed does happen in the next 3, 6, 9, 12 months, whatever, that people have taken some precautionary measures that they can do today to make sure that they're not just completely, sandbagged by this if it happens.
Yeah, but Adam, this is basic financial planning stuff 101. This isn't something that we should just be doing now because we think there's a recession coming. This is stuff we should have been doing all along.
You're right.
And unfortunately, like I was reading an article today, 36% of people that make $250,000 a year are living paycheck to
paycheck.
There is no reason that should be occurring. No reason at all. If you're making $250,000, and it's mostly these are mostly millennials, they're living in too big of a house, driving too expensive of a car, right, traveling too much, whatever,
eating out a lot, and all that stuff.
And Grubhub and everything, right? So you pay an extra 30%, then they eat your food on the way to delivery. Right. That was another article out today.
I did see that.
So, but the point is that there's no reason if you're making, if you've got a job, there's no reason that you shouldn't have 6 months worth of salary already saved up. That should have been done years ago. There's, your credit cards, you should be paying those off every month. I mean, there's just some basic things you should be doing, and I throw this number out a lot and people go, whoa, there's just no way. You should be saving 30% of your income.
Totally agree.
Right. And that's not hard. By the time you fully fund your 401k, if you make $100,000 a year, you put $26,000 into your 401k, that's 26% of your income right there. It's not hard to save 30% of your money, right? And then you save a little bit extra on the side in cash to cover emergencies. It's not hard to save money. We just don't teach people how to do it. And then we get into a problem situation where we are now. And now we're going, okay, you need to prepare for the downturn. Should have already been done. But if you haven't done it, Adam, to your point, now's the time to start preparing because we're going to have an economic storm. Again, I just don't know. I can see the clouds on the horizon, just don't know when the storm is going to be here.
Yeah. Okay, great. So key point is look, if you hadn't done it before, don't worry about it. It's not too late. Get going.
Yeah.
All right, look, so a couple quick things for the back half of this conversation. First, you mentioned it super briefly, but trades for the week, what did you guys do?
We sold one position that we actually liked. It's a good company, Waste Management. We owned a small position in it. We liked the company a lot, but we needed to raise some cash, and it was one of our least best performers on the value side of our benchmark. And we're already pretty underweight technology at this point. So we had to pick somebody to shoot, and Waste Management pulled the short straw. So, but again, we'll buy the company back at some point. Again, we like the company long-term because if you have a house and you have trash, you got to pay somebody to take it away. So that's just kind of the bottom line of that. We also just trimmed back on a couple of other positions. We also, it's interesting. We did trim back in our sector model. We run a portfolio of individual stocks, and we also run a portfolio of ETFs. In our sector model, we actually trimmed back on our energy exposure because energy is so overcrowded right now. There are too many people, too long energy. Energy is trading 4 standard deviations above long-term moving averages. Crack spreads are just out of control on that side. And whenever crack spread, look, we've got a crack spread going on right now in oil.
Sorry to interrupt, but can you just define for people who don't live in Houston what a crack spread is?
Yeah, but honestly, it's not that important. It's just the differential in prices that affect the refiners and what they produce at. And it's not that important, but the point is that spread is the largest in history, and it can't last very long. And so and I don't know what's going to cause the reversion in oil prices, but it's coming. And, we're going to see a fairly substantial downturn. Energy stocks are, like trading 40% above, the relative performance of the S&P. Is just, these deviations are at extremes that don't last for very long historically. And the one thing about energy stocks in particular and oil prices, they don't correct a little bit, they correct a lot. And so when these prices do correct for whatever reason, and again, I don't know what's going to cause it. Could be, a spike in the dollar. Could be, tomorrow we wake up and OPEC Plus says, guess what? We're going to turn on the spigot. Or the administration wises up finally and says, fine, what, we're going to let you start drilling. Here's leases to wherever you want to drill. Whatever it is, there'll be something that changes the sentiment in the commodities market, and oil prices will correct fairly sharply. So I know it doesn't seem like that's going to be the case right now. And everybody's like, oh, oil prices can only go to 200. But listen, been here, done this for 30 years. And I've seen so many. Adam, you remember peak oil back in 2008. Oil prices are going to 250 because we're running out of oil. Yep. And then we discovered this little thing called fracking, and then we had too much oil.
Right. So, well, and to your point, just of how extremes can really, quickly reverse with big magnitude, is 2 years ago, oil traded below $0 for a brief moment, right? I mean, exactly. we had way too much of it, and it was never going to trade in double digits again, and of course here we're back up over 100. Let
me tell you about the two worst investors on the planet: doctors and oil people.
Okay.
Because when oil prices are spiking, they go out and they drill everything they can drill, and then they drive themselves into bankruptcy when oil prices collapse. They're always on the wrong side of the trade consistently throughout history. So again, just take that with a grain of salt. If you're super long energy, take some profits. It doesn't mean sell everything. We just trimmed our position, actually for the last year. Every time our position size gets way overweight, we just trim it back to target weight, take profits in, and it grows again. So, it's been a fantastic trade in portfolios. But again, don't forget to take some money off the table, because again, you can wake up one morning and 30% of your money can go away just like that.
All right. Yeah. Very good warning. I chuckled when you put doctors in there with oil investors, only because I'm from a family of doctors. So my siblings are all doctors. I feel like I can kind of join in that joke, but this is maybe, I'm going to flag this for maybe digging into in a future, one of these videos, Lance. Doctors are really disadvantaged. And I think you can make a similar case for a lot of professionals where there's a really long educational track to get there. As a doctor, it's expected that eventually when you become mature in your profession that you'll be making a good living. You know what they don't teach you in medical school?
How to save money.
They don't give you a single class about money management or about how to run a business. And a number of doctors are expected, to form their practice and basically run it as a business going forward, but they give them zero background in that. And so these poor guys are working so super hard, and they're taxed for years and years and years and years, learning a ton of really important information, but they're sent out almost naked in terms of how to sort of financially fare once they're out in the world, right? And of course they also have massive debts in many cases to pay off before they even get to the point where they can start putting money away.
Right.
It is kind of a travesty, and I'm not trying to make people shed a ton of tears over doctors specifically, but there are a lot of kind of high performance professions like that where we really do a massive disservice. It's an unnecessary disservice for these people to with a little bit of training, we could make we could get them off your list of the worst investors. Let's put it that way.
Yeah.
All right. So real quick, there are two other topics I want to get to, but real quick, bonds. So it looks like yields began creeping back up this week. Is that anything that's off plan in your mind, or?
Nah, and the thing is yields have been bottoming now here for a while, and then we had a nice little run, and yields had come down and bond prices have gone up. They got overbought, seen a little bit of a pullback here, not surprising, and still on a buy signal, but kind of like the market, right, pulling back here a bit. We're seeing a lot of buying though intraday. Like this morning was a good example. On Friday, bond prices were down about $1.20 in the morning, 1.2%, 1.3%. Cut that loss in half by the end of the day, even though interest rates were up. And that's because there's a lot of buying going into bonds right now. And I think we're going to continue to see that. But, in the short term, you're going to have a lot of this oscillation. The bond market's still trying to figure out what the Fed's going to do. The Fed's trying to figure out what they're going to do. Nobody's for sure what anybody's going to do. But again, when you start looking at, why do you own bonds in a portfolio? They dampen volatility. And when we get into this economic hurricane phase or economic rain shower or economic sprinkle or whatever it's going to be, bonds are going to play to your favor, because once you start getting that disinflationary pressure and recessionary pressure in the economy, that's where money's going to flow to. But that's, as we've talked about numerous times, the bonds in our portfolio are a longer term play, and it's something that we're betting on for the next 12 to 18 months.
Okay, great. So just long story short, you're holding, you're not selling, and you're still thinking about potentially buying more in the future.
Yeah, but not yet. We need a little bit more clear signal so right now we're at target weight on our long duration portion of our, so our bond portfolio is 40%. 30% of the portfolio is super short duration. It's floaters and very short duration bonds. So there's, you have a little bit better yield than money market, but basically it's cash.
Right. I mean, almost no risk because you're getting your principal back within a couple of months.
Exactly. And then, so we have 10% in our portfolio and long dated treasuries simply for this longer term bet. So once that bet begins to pay off, all of that short duration cash will go long duration, but not until we see the thesis begin to play out. So it's a very small weight in our portfolio right now, but again, it'll be a much more important weight as we go down the road.
Okay. All right. All right. So now we get to the rant part of the discussion here. I actually don't want to go too deep into this one just because I haven't researched it enough to be sufficiently
don't start it.
irate, but I want to flag it because I think we may pick up on it in a bit. So the administration announced yesterday that Department of Education announced that they're giving $6 billion in college loan forgiveness. Yep. Right. So we talked a bit about this a week or two ago, that this could happen, and the moral hazard that student loan forgiveness, if you crack that box open, can really unleash. This one, there are people who presumably were taken advantage of by this company that owns several colleges, and so they're trying to kind of like almost like FDIC insurance, like help out people that got taken advantage of. I don't know. It's a little.
But wait, let's back up a little bit because they need. If you're going to talk about it, we need the backstory here, which is we're talking about Corinthian colleges, which was one of the largest for-profit universities in the country. They had multiple locations, and they were basically, ramping these students in and not really giving them an education at all. And then they got sued for it and filed for bankruptcy. So it left all these students kind of hung out to dry. With, in a lot of cases, they were hung out with student debt and no education because they filed for bankruptcy and couldn't complete their education. So, there's part of me on this particular issue that says, okay, in this particular case, if you can prove that you were shortchanged on, getting, and I think there just needs to be some process put into place. Hey, I was halfway through my education. They closed up the college and I wasn't able to complete, and I had all this student loan. Okay, we're going to give you your student loan money back, so you can go get a student loan, go to college somewhere else. I'm okay with that. Yeah. Right. But what I'm not okay with is, they graduated the college, they have their degree, and then you're going to forgive $10,000 worth of their student loan money. That, again, there's as the problem as always with government is we go off half cocked and we don't really kind of analyze these things. But in this particular case, I can understand some of the reason for wanting to forgive the student loans but this is an administration issue. They just want to show that they did it, right? Because this was a campaign promise that we're going to forgive student loan debt. They couldn't get it done, but this is an area that they can do it with an executive order, and it affects a very small number of people. Again, 5.6 billion is like 5.5 cents based on the $1.5 trillion of student loans that we've got out there.
Yeah. Right? And that's why I said, that's why I said I didn't want to spend too much time on this because I'm still sort of researching it, and it's small relative. I mean, still $6 billion isn't nothing. But
it's a slippery slope.
I think it cracks open that door, right? Yep. That's what I'm talking about here. And in their announcement, and just so you know, they're refunding everybody back to the Corinthians founding in 1995. So it's 20 years of people, many of whom have actually went through all 4 years, like you mentioned. And it's not a small number of people. I mean, it's over 500,000 people.
And I wouldn't do, and that they shouldn't do that. If you were in 1995, you got your education, you've had a job all these years, you owe the debt. Sorry.
Yeah, well, that's the moral hazard that you and I already pre-ranted on earlier. The thing I want to flag though about this is, in the announcement by the Department of Energy, they say, including this group discharge, the department has now approved $25 billion in loan forgiveness for 1.3 million followers. And then they are working on new regulations that will permanently improve a variety of existing student debt relief programs and provide. So basically, they're just saying, look, we're kind of just getting started here, right? And I think that's the thing I wanted to flag here, which is, if you're troubled by the moral hazard that student loan forgiveness creates, I think this is almost like a preview of coming attractions. So we'll track it. We'll get our full rant on if indeed we see more of this happening in the future.
Well, but one thing about this though is, look, if you want to look, we talked about the moral hazard, right? Look, nobody forced you to take out a student loan. Now, if you were defrauded, if you took out a student loan, I went to Sallie Mae, I took out a student loan, and then the college defrauded me, right? Okay, well, that's a criminal issue that needs to be dealt with by the Department of Justice. But yeah, it's, you need to either give me my money back or forgive my student debt and give me a loan to go somewhere else. Okay, I can work with that. I'm okay with that for those specific individuals. But one thing that we do need to fix is that Sallie Mae charges a 7% loan rate on student loan debt, which is twice as high as, the 10-year treasury rate right now.
Right.
So, if we need to fix something on student loan debt, first of all, let's just lower the interest rate to a normal interest rate relative to the rest of the economy. That will ease up a lot of the payment structure on these people.
Yeah, and sorry to interrupt you, but you're being generous because that Sallie Mae loan has been at that rate in that territory for a while, whereas the 10-year has actually been a lot lower for the past bunch of years. So it was even worse for the past, long period of time, right? Yeah. So, totally agree. And it's look, I mean, we've already kind of talked a bit about this, but obviously if you do this, you send a message to everybody who's going to start applying for debt that I'm just going to leverage the hilt because obviously it's going to get forgiven at some point. But then you also, it's so preferential in an arbitrary basis where everybody who either paid to go to college and isn't in whatever, bailout pile of cash you're giving out there, well, that's terribly unfair to them. And it's really unfair to all the people who forego going to college in the first place because they did the fiscally responsible thing at the time, right?
What about all the people that paid off their student loans?
That's what I'm saying. Yeah. Those people who did, you're basically saying, well, it sucks to be you.
Yeah. And again, and then, this is what I said before is look, if you want to forgive the student loan debt, okay, great. 1.5 trillion, wipe it out. But then you got to shut down the student loan program. You can't do it anymore. Once you wipe out everybody's student loan debt, you say, okay, done. All the debt's forgiven. You can't then turn around and start giving out student loans again. You've got to shut down the program. Because what about the next people that come along and take out student loans? Are you going to forgive that debt too?
But that's the moral hazard. Yeah, exactly.
Exactly. And so at some point, you just might as well just say, look, go to college and the government's just going to pay for everybody's college. Just you will send the checks directly to private colleges across the country. Just right. It's all free now. But this is all taxpayer money. And what everybody forgets is that when they forgive the student loan, that's your money. You pay. This was taxpayer dollars that was wasted through these student loans. You're paying for this. And, ironically, what everybody forgets is we didn't have this problem pre-2008.
Right, when we had private lenders managing it.
We did not have tuition out of control. Tuition was rising with inflation in the economy, but tuition was very affordable. You didn't have these problems. You didn't have this massive student loan debt. As soon as Obama administration took over the student loan debt, this whole thing went AWOL. And so, we need to A, get government out of it, and B, put it back into the private sector where it belongs. But you can't do the student loan forgiveness thing without ending the program entirely.
Right, which I don't think they're going to do. Now, look, this cracks open, I think, a very valid discussion of, hey, should we have free higher education in America? Other countries do it. I'm all for that discussion. But, what we're doing here right now, and we already spent way more time on this than I wanted to, but it is woefully imperfect, unfair, broken, and
but Adam, let me, I'm going to just say one thing to you, my friend, because I like you. There was a point in time pre-1980 before the Department of Education took over our educational system, the government, that we ranked 1, 2, 3 in science, math, reading, technology everywhere in the world. Okay, since 1980, when the Department of Education, the government, took over our education for the K through 12 education system, we now rank somewhere between 20 and 30 in around the world. Estonia ranks higher than the United States in reading, math, and science, right? I mean, putting the government in charge of education is not the solution. It leads to less quality it leads to poor quality education. Look, you went to Stanford for a reason, because you wanted a high quality education. You were willing to pay for it. And as soon as you take universities out of the private basis where they're charging to hire the best professors, hire the best, the best staff, et cetera, to give you the best education, what you're going to get is K through 12 education and what we call a higher education system. And we get even further down that education list. It's the worst decision we could make to put government in charge of higher education.
Yeah, and look, I don't want to come across as saying that that is the answer. And honestly, I very much share your general perspective there. That let's have a market-based solution because you tend to get way better results for that. But I feel like, look, let's have that discussion out in the open and debate it on its merits, and then hopefully pick the winning decision. Because what we have right now is essentially a government, what do you want to call it, sort of backdoor bastardized subsidization of a very inefficient and unfair system, right? Exactly. So anyways, all right, moving on to the thing I wanted to conclude on, which is a headline that came across today that says both Social Security and Medicare programs are heading towards insolvency in the coming years, according to annual reports released by the trustees of the two programs. The Social Security program will be insolvent in 13 years by 2035. Once the program becomes insolvent, all beneficiaries will face an across-the-board benefits cut of 20%. Meanwhile, the Medicare Hospital Insurance Trust Fund will exhaust its reserves over the next 6 years by 2028. Yeah. So we're already having the people that run these programs basically say, hey, look, folks, we're getting near the end of the road here where we're really going to truly start running out of money here. I'll let you go on that one before I get my rant on.
Well, no worries. I mean, I've got an article coming out on this called Whistling Past the $70 Trillion Graveyard. The unfunded liabilities of Medicare and Medicaid are astronomical. It now takes more than 100 cents of every tax dollar that comes in just to pay for Social Security, Medicare, Medicaid, prescription drug benefit, and interest on the debt. So that's where your tax dollars go. Everything else we want to spend money on, that comes out of debt that we have to issue. So Department of Education, that's all debt that we have to issue. But the bottom line is that unfortunately, nobody's going to do a thing about this because it's a politically unelectable topic, right? There's only one way you fix this. And everything that we're doing right now is actually making the problem worse. They're now talking about extending Social Security now to even more recipients that it'll have to cover. So more money going out at a time when you have less people being born. We have the lowest birth rate since World War II. We've got just barely more than 2 people paying into a system that we have people taking out of the system. That used to be 16-1 back in 1940. So you just have too few people paying in, too many people taking out. And look, this has been a problem that started back in 1960. We started adding firemen and police officers and teachers and widows and orphans and everybody else you can think of. Anybody that needed a benefit or a handout from the government, we stuck them on the Social Security. And now nobody knows how to fix the problem. There's only one way you fix it. You've got to cut the number of people or the amount that is being drawn out of the system, and you've got to increase the amount of money being paid into the system. But nobody wants to do that because as soon as I start running for office, I'm going to run for office. I'm running for president 2024. Here's my platform. I'm going to fix everything. I'm going to fix Social Security. I'm going to fix Medicaid. I'm going to fix the economy, and I'm going to reduce the size of government, right? I'm returning everything back to the states, Department of Education, energy, everything that's going back to the states. The states can run their own business. I'm going to run national security. I'm going to run, basically public works out of the government and make sure the country operates. Outside of that, everything else belongs to the states. I'm going to fix Social Security. We're going to raise the retirement age, and everybody that is lower than the age of 35, guess what? You don't get Social Security at all. You're going to pay into it, but you will never get it. That's the only way you're going to fix it, but you won't vote for me for that because everybody that's on Social Security or about to get it, they're saying, you can fix it, just don't take my money.
Right. No, exactly. So it's the biggest voting block, right?
Exactly.
Yeah.
So the only way this gets fixed is it has to break. And when people start getting less benefits, then people will figure out a way to start fixing it, but not until then.
Yeah. So, I guess that's sort of where I was going with this question is, this is just one of those things where, look, there's 2 ways to change. right? You change by insight, where you say, look, if I keep doing what I'm doing, it's going to have a bad ending. So I'm going to change my behavior today, right? Humans being humans, we hardly ever do that. Right. We end up changing by pain, right? You don't really change your lifestyle until you have that first heart attack, right?
Exactly.
So this seems to be like one of those things that we're just not going to do anything to, begin to reform it until we just smash into it.
Yeah,
head first, going 100 miles an hour.
So I have this argument with Richard Rosso all the time at the office. This is one of our big debate points, because he's like, Lance, you don't understand. If they start cutting benefits on Social Security, you're going to have people living in the street. And he's right. There's a big chunk of the retirement baby boomer generation that are solely dependent on Social Security to make ends meet. And he's like, you're going to have people stepping over people's bodies in the street, if you start trying to fix Social Security. And I'm like, hey, look, it's not me. It's going to fix itself at some point. And to your point, exactly what you're saying, you have the choice to either start making small changes now that have a big impact later. And they're not fun, right? I mean, there's going to be people that are going to lose some benefits, right? You're going to have to cut them, and you're going to have to raise the retirement age. You're going to have to get people to contribute more. You got to remove the Social Security cap. And, that's got to people, if you make $5 million a year, or Jamie Dimon, you make $1 billion, you're be paying a lot of Social Security tax, because those caps have to get removed. But that's the only way you're going to fix it, because if you don't fix it by making small changes, to your point, one day you're going to wake up and the system will fix itself, and it'll be all at one time, and you won't have a choice.
Well, and I'm not sure even at this point, if you wanted to, I don't think those steps could be small. I mean, no. We're talking about 13 years and 6 years, right? I mean, there's not a lot of time left. And of course, they don't go to zero at those dates, but it's really where we're getting into true insolvency.
You got to stop adding people to the rolls. Illegal immigrants come here, they get access to the rolls. I mean, you've got to stop adding people to the rolls other than what it was meant. Look, Social Security was meant for one thing. It was meant for when you retired, it was, and you left work and you were no longer able to work because of your age. And this goes back to the 1930s. You were people only lived to 65 years old anyway, to max. So we lived too long. Our longevity's gotten way too long. But the thing is when you retired, it was a supplemental benefit to help you through retirement, right? When you can't work. But then we started adding all these other people on. And look, they're all great reasons. I'm not opposed to the fact that we added widows and orphans and other people to Social Security, and that, your wife that hasn't worked, she gets half your Social Security when you pass away. Those are all great things. We just can't afford it. So you're going to have to figure out a way to stop adding people to the rolls and get more people to contribute. It's just math, right? I mean, it's just a function of math at the end of the day.
Right, exactly. And so anyways, reason why I sort of brought this up was just to say, look, there's, whether, we get Jamie Dimon's economic hurricane in the next, 9 months or whatever, right? There are reasons to take some preparatory steps now for what might happen, right? Within the next year. But I think things like this tell us, look, there are reasons that we may need to take some preparatory actions for things that may manifest in the next 10 years or 15 years, right? So part of this might be like saying, sit down and say, what will I do if I don't get a Social Security check? Right?
Yeah.
What if they do means testing, or there's just not money or whatever, right? So, what does that impact in terms of the year by which I think I'll be able to retire if everything else goes to plan, right?
But look, this is always the case. And I tell people this all the time and they don't like it, but you should plan for retirement to retire on your assets. If Social Security is there, that's great, right? It's an additional benefit. And you just get some extra money, you can do some extra stuff with it. But plan to be totally solvent in retirement on your own. If you do that, then nothing else is a concern, right? Plan for the worst, and then anything else that happens is better. So, my financial plan doesn't include Social Security, Medicare, Medicaid, nothing, right? Now, if it's there, great. It's an additional benefit, but I'm planning to retire on the money that I've got saved and invested. That's my goal, right? That's my personal goal. That's my wife's goal. But, and I think if you do that, all this becomes, secondary, and you don't have to worry about it. But, the problem is if you want to fix Social Security, just don't take my Social Security away, because I'm 57. So, you can fix it for anybody younger than 55. Just leave mine alone.
Yeah. I mean, that is the problem, right? It's our mentality. Well, look, I think really that may be in this very long video that we've just recorded here. So thanks for you folks who've made it here to the end. I think that may actually be the biggest gem of wisdom to take from this, which is, as you plan your larger financial arc of the rest of your life. Plan it as if you're going to get nothing from anybody but yourself, at least governmental support wise. And that everything else that comes beyond that's gravy. But if unfortunately, you're unfortunate, you get there and all these government programs have gone kaput, at least you've put in all the time and effort and savings to take care of yourself and the people that you care about. I'll end this topic just on a quick note. So I've got a family member that is one of these older people who no assets, and Social Security is the only income that's coming in. It is not a great lifestyle, folks. Just I can tell you firsthand, it's not something to aspire to. But this family member had been divorced a couple of times, and doing some research on their behalf, I found out that they might actually be able to up their Social Security payment by taking both ex-spouses' lifetime payments in the Social Security system into account. And so I called the Social Security office and kind of went through this process. And they agreed that, we can, increase the Social Security check by an extra $100. I can't remember what it was. But I was like, well, that's really interesting. So I was like, I'm just really curious. Like, the Social Security system wasn't planning for me to call and ask for this extra money. So where does it come from? And the person's answer was, well, the government just prints it up. And the government just comes up with the money. I'm like, okay, but I know that they're running at a deficit. I know that they weren't planning on people like me calling and negotiating a higher payout. So I'm just really curious, like, where does it come from? And they didn't know. They clearly didn't understand, how the system works. But the mentality was just, oh, the government just invents it. And that was a fine bit of logic to them. And this is from somebody who's in the system, right? So I think that's pretty indicative of how a lot of the people running the system, including scarily a lot of politicians, think about it, where there's just a magic money tree that we go to at the government and we pull money off it and we take care of it, right? There's no sense of how is this being paid for in the long run? What might the long-term repercussions be? All that type of stuff.
Look, there's a simple number for you: $30 trillion. I mean, look, if you don't realize by now that what the government believes in is just like, there is a magic money tree. It's called the U.S. Treasury. We can just issue debt. We can do $5 trillion in checks to households. And look, when we get into trouble again, it doesn't matter. I said this before. It doesn't matter whether the conservatives are in control or the Democrats are in control. It doesn't matter. The first thing they're going to do is run back to the printing press, send checks to households, because that's what gets votes. We have no fiscal responsibility in government, and that's the biggest problem with all these programs. And again, the easiest thing to do is just to issue debt, issue more debt. There's no consequence for it. And we're already at 130% of debt to GDP. The consequence, unfortunately, for all of the younger generation coming up, the millennials are starting to get the first whiff of it. The group after them and the generation after them are going to get the brunt of it, is that all this debt leads to slower economic growth and prosperity. So you talk about wealth gap problems being a problem now. The 1% is going to own everything in about another 15, 20 years, because there will be very little economic growth. And if you don't believe me, just go look at Japan, which runs at 230% of debt to GDP. Their interest rates stay at zero. Their economic growth stays at zero, and they have recessions every 3 to 4 years. So that's the future we're headed to.
Right. And their currency is tanking right now because they're doing that yield curve control. Right. So, and that's the immorality of this. And this is a topic for, we could take probably a whole series on this, but, we have been borrowing for generations now. We've been living against our means, borrowing against our productive capacity, and we've been sticking future generations with the tab. And we're now getting to the point where we can see the impact on those future generations. So millennials are the first generation to empirically have diminished financial prospects versus the preceding generations, right? And Gen Z is going to get stuck with this even worse, right?
But unfortunately, the millennials and Gen Z solutions are MMT. Just give me more money because that's what's fair, rather than looking at the benefits of capitalism to solve the problem. They're looking more for socialism.
Exactly. And this goes back to the lack of financial literacy that we railed about in last week, right? And it's totally understandable, right? Hey, I'm hurting today. I need to put food on the table to feed my kids today. Please give me some money, right? But not realizing that is actually just, more of the thing that created the issue in the first place, right? Exactly. So, sorry, folks, to kind of end this on such a, depressing scenario here, but I think a key takeaway from this is that there's a lot of stuff happening systemically that is not sustainable. And, we're on this channel going to try to help you prepare for where the markets are going so that you can, build wealth to just be generally prosperous, but to also build financial resilience as some of these bigger, systemic chickens come home to roost over the next couple of years, couple of decades, et cetera. All right, Lance, I'm going to wrap up. Any last parting words before I do?
No, I'm so depressed now. I'm just going to go drink.
Okay. All right. Well, look, folks, thanks for making it to the end of this video. If you like these weekly, I was going to say discussions with Lance and I, maybe they're now more accurately described as old man rants. But if you like them, please do me a favor, support this channel, hit the like button. And if you haven't subscribed yet, click the red subscribe button below, as well as that little bell icon right next to it. 2 quick resources. One, if you missed last week, I referred to our layoff survival guide. If you are an employee of somebody, there are a number of steps you can be taking today just to reduce your vulnerability in case you, hopefully not, but in case you get a pink slip at some point over the next year or so. Just go to wealthion.com/layoffs and go read that. It's totally free. And also, I think we probably gave a lot of reasons in this discussion here to, revisit your financial plan, to, really get hardcore about how you want to position your assets for what might be ahead. If you haven't yet talked to a professional financial advisor, folks, take this as the urge from the universe to go do so. If you've got a good one already in your life, great, stick with them. If not, though, or you'd like a second opinion by an informed one, you can go talk to Lance and the folks at his firm. They are one of the top endorsed financial advisors by Wealthion. To go set up a free consultation with them. They'll literally sit down, talk with you. There's no expectation to work for them. It doesn't cost you anything. Just go to wealthion.com and fill out the short form there. Lance, thanks so much, buddy, for another fun, even though it was depressing at times, fun and wide-ranging weekly recap. And whatever the markets do next week, I'll see you here on this channel next Friday. Thanks so much. And everybody else, thanks for watching.